got the receiving end of it. Hello, if you can hear us, welcome to this week's ASX Reporting Season webinar. We're just giving it a bit of time just to let this webinar filter out into the ether. I'm joined by Leigh, who is somewhere on the screen, partner in crime here on the ASX Reporting webinars. In fact, these are all Leigh's ideas. So if it's bad, just send it his way, wherever that is. And if it's good, happy to take the praise. But seriously, welcome to today's live stream. Last week's was a little bit later at 7 p.m. And this week, we're just going to try and tap into the lunchtime crew who may be setting up for a big week, maybe looking at the market, or what's going on in the ASX, the reports so far, and just want to kind of get some ideas. We're going to walk through some of the technology and these types of things. I can see that Jenny and Jane have already mentioned PME, Pro Medicus, which we did talk quite a bit about last week. We will talk about that today. It's actually Leigh's, he's got his smock on and he's got some creativity and he's put some memes together for us, which we'll get to today. So one of those has to do with AI and software companies. So we'll talk all about that. But maybe just to start off, if you have been buying any shares this week, just chuck it in the chat here on YouTube. If you're watching somewhere else, like on LinkedIn or X or Facebook or whatever else you're watching on, because this streams to multiple destinations, best place is the Rask YouTube channel. So go across there so you can comment live and we'll be able to see that. But let us know in the chat. First up, Leigh, how you going?
Great, mate. Very happy Monday. Sun's out. It was a great weekend. I reckon the bulk of reporting season is kind of finished as well. Like it was quite a busy week last week for anyone following companies, but also like writing stuff for the Rask media site. So I think we've gotten over that hill now, and hopefully that means headlines are dying down, but probably not.
Yeah. Well, there's a lot going on, right? A lot. Normally you see the confession season is just before reporting season, which is when all the real bad news comes out, which we'll talk about in a minute. But it seems like even when companies are reporting results, they're still getting thrown out. So there's been a lot going on. And as Leigh alluded to, everyone, you can head to raskmedia.com.au and you can see daily ASX updates and news and reporting by the team. So if you're into ASX stocks, if you're into ETFs, if you're into any form of investing, head here. It's updated every day. Leigh, myself occasionally, and many people in the team write articles and share research. So you can jump over there. And this is all getting a bit of a facelift in the next little while. So exciting times. Before we get into the companies, it's really important to remember that we are here giving general financial advice or general financial information, which is like how I think about it. Only we're not giving you personalized financial advice, even if we respond to some questions in the chat. Like I can see Montgomery's just put something in here saying they bought Xero, Pro Medicus, Rocket Lab in the last week, and we'll pick up CRM, which is Salesforce, Disney, Adobe, and Visa in the near future. Wow. I'd love to know, what do you think of the software kind of sell-off at the moment? Trent said he's bought Catapult and WiseTech. So like if we respond to these things, right, guys and gals, we are not giving you personalized financial advice. If you do have questions, try to keep them general or just like company specific. And that's one way that we can make sure we answer your question. Because we don't know your needs, goals, or objectives, you should speak to a financial planner before you act on the information that we discuss today. You can find more information in the Rask Group's financial services guide. That's at rask.com.au/FSG. Now that we've got through the bit that everyone absolutely loves, let's continue on. So myself and Leigh here, both business owners and both investors for quite a while. Leigh, while he looks younger than me, has been investing longer than me. So keep that in the back of your minds, and maybe that's a symptom of the types of investing that we do or the types of businesses that we've run. So Leigh, I think you've got some questions. You want to set the scene for this before we get into the companies?
Yeah, absolutely. Put the spotlight on you. I couldn't find a picture of a chair on fire, so you're not in the hot seat. You just got the sort of the inspector's spotlight shining down on you. Although that could be the center stage. I'm not sure, but take whatever analogy you want. These questions are directed at you. So I think a lot of, not just our own, but broadly, a lot of reporting around earnings and reporting season has to do with surprises, right? So the company A had a earnings surprise, like they beat earnings expectations. And so there's sort of two things that play here. One, usually management will come out and guide the market. They'll say, oh, guidance for the future outlook is A, B, C, D on revenue or earnings. And then also you have analysts saying, oh, our expectations are that, company A will earn this much in the next half or year. If those are coming out all the time, why do we even have surprises? What's going on there?
Well, I think it's like we've got Pro Medicus up on the screen here. A lot of the big surprises have come in the technology scene lately because of actually something that has very little to do with the companies themselves. So the fundamental performance, which we'll talk to today, has been very good for many companies. Very, very good. Like if you take two of the companies that have been hit the hardest, which is Pro Medicus, maybe we'll take three, Pro Medicus, Xero, WiseTech, which are three of the biggest technology companies, actually are all growing. And if you look at Temple and Webster, growing. Even businesses like Nick Scali, like not rapid growth style businesses, but high quality franchise, no doubt, growing, still gets sold down, right? And so a lot of that is just pure sentiment. And you can kind of see like a narrative arc over the last few years in relation to all of what's happening, which is the first one was like, ChatGPT is like useful and kind of quirky, or it could be useful. And then maybe early last year, people thought like AI, oh, cool, it can help me draft an email or maybe something like this. And then all of a sudden, as that is advanced in the background, now people have realized, actually, holy heck, this could be like agentic. It could do things for me. It could actually automate tasks. It could replace whole divisions of businesses. And so companies that are reporting results, they're just reporting their financials, right? They're not commenting on what's happening in the sentiment shift around the world that's happening so fast. So that's just one example of how these outside forces can impact performance. And I think, when we think about guidance and these types of things, a lot of the time it just comes down to narrative. I remember getting pitched by a sales guy who worked for this big fintech in Silicon Valley like 6 or 7 years ago. And the big value prop for his business and what they were building, it was a big business at the time, is they were building this language pattern recognition software for investors. And effectively, you would put your your reports in, like your quarterly reports or your annual reports, and you'd put them in there and it would do sentiment analysis and just plot them across like a chart. And then from that sentiment analysis, because it would run so fast, you could then use it to make decisions during reporting season. Like that was like their big prop. And it goes to show that it's not just the numbers, but it's also everyone else with their sentiment and their kind of perspective on it. And I think that's probably the big thing that I've learned over the years. I know you've been doing this a long time too, so maybe I'll return it to you. Like, why do share prices bounce all over the place when, the results look pretty decent?
Yeah, I think, and we showed this last week, there's charts definitely that in the short term show that the biggest impact on share price is not really the underlying business, particularly in the short term. So whether it's to do with guidance or earnings and something coming out like a news story or a narrative that may impact that. So it doesn't necessarily impact that. It's more the narrative that it may impact a company's earnings or revenue or growth story, that the sentiment can shift. So, big swathes of investment can leave a company just because a narrative changes, and it's essentially irrational, right? So I think, Warren Buffett and even his teacher, Graham, have said always that in the short term, it is noise that impacts a business's share price. It can just move up and down changes in the wind. But over the long run, it's earnings that will guide a business's share price. So essentially how much money a company makes will eventually mean its valuation goes up or down in the very long run. So, I think on guidance, it's interesting that, I mean, it's been, in many ways, the US is ahead of Australia when it comes to business, and more businesses in the US are no longer providing guidance in their quarterly earnings. So it's a bit even more frequent in the US, where they have quarterly reporting, and management teams are no longer providing guidance as forecasts for what's going to happen in the next quarter or year. And I think you're seeing some companies starting to entertain that here as well. I quite like it. I don't think you should come out and try and pinpoint exactly even a short or small range as to exactly how much revenue you're going to earn in the next 6 months, because there's a lot of unknowables that are facing us, our businesses and such. So I just don't think it really helps. But if you talk more about operations and, you know, what has transcribed and what will be happening with your business, it's actually more helpful you know, to think rationally that way, because at the end of the day, it's all about business, not really about, you know, how you're feeling.
Definitely it is. There was a question that came through from Jacob about GYG. So we're going to talk about GYG. We're going to talk about Pro Medicus. We'll probably talk a little bit about Catapult, a few of these other names. So we've got a bunch of these. G-Man said they bought Soul Pats, which is cool. And looking at T&E, Technology One, which is great. So actually, I think we can do two birds, one stone here, Leigh. I'll bring up the slides just quickly again. For folks that are looking. So Leigh's going to take us through some of the losers that he's identified, like some of the companies that seem to be losing based on the shift. But we're going to talk about passive investing, and maybe I'll start and then I'll throw to Leigh on these companies, because GYG is one of these companies, and I think it illustrates the point around effectively what happens in financial markets is not always just like the company performance, as we're about to find out. One of the influences that has definitely gained traction over the past few years is passive investing. And some of you may remember GYG is Guzman y Gomez, which is the Mexican kind of fast food giant now. Competes against many of them, but the big one is, I've forgotten off the top of my head. What's the green one called? I've forgotten off the top of my head. Oh, Zambreros. So Zambreros is still privately held. Quick poll of the community: do you prefer GYG or Zambreros? I'm a Zambreros kind of guy. Just as a quick aside. Leigh, I don't know if you've had either.
I have. I don't. Let's just say I don't have a strong preference for either. I would say it's probably last resort style eating for me.
Yeah. Oh, get off your high horse, mate. Okay, but just quickly, just on this. So Guzman IPO'd not too long ago, and it was one of the biggest IPOs at the time, and it was kind of in that sweet spot around the time of Chemist Warehouse when it IPO'd, and it was in a sweet spot not just in timing but also in terms of the size of the company at the time of the IPO. Because one thing everyone needs to understand here is when you put your shares on the stock exchange, there are certain rules that get it included or excluded from the index, like the ASX 200, the ASX 300. And one of those is that you need to have free float. So you need to have enough shares of the company to be included. You can't just be the biggest. Some people think that the ASX 200 is the biggest 200 companies. Well, that might be a fair generalization. It's not actually technically true. There's a whole other bunch of criteria that go into it. One of them is called free float. And so what you can do if you're an investment banker is you can effectively know those rules and then play into them, and know that if your company is going to be pitched at the right size and the right valuation, you're going to be going straight into the index, and then the index funds are required to buy your shares, which pushes it up. And the reverse can happen, is you can push it down. That's right. So I definitely think that this kind of capital markets activity is having an impact on companies, not just at the time of reporting, but also during IPOs, which is that first time the shares come to market. Now, Leigh, that's beside the point for this. You've actually outlined from all of the reading and research that you've been doing with the team over this reporting season that some of these companies are actually kind of in the crosshairs for a different reason. So do you want to maybe elaborate on that? Like why did you name these companies as the losers?
Yeah, I thought we'd highlight Guzman y Gomez because I think it covers all 3 points that are we've jotted down there. Like before earnings came out last week, I think you would have found that GYG was trading at a multiple of around like a PE, of a price to earnings ratio of around 103, where Pro Medicus was maybe in the mid to high 80s at one point. So at one point last week, you were paying more for every dollar of earnings from burritos than probably the best software for hospitals going around. So, I think Pro Medicus and some software gets talked about as, really, really high valuation and expensive, but perhaps the growth rates for the revenue and margins that something like Pro Medicus can generate would be worth more than, say, how many burritos you could deliver through a drive-through. So I don't want to hang too hard on Guzman y Gomez because it does have its fans, but I think you have to really consider valuation when it comes to something like Guzman y Gomez because of where it trades at. So like you're saying with IPOs, you have to watch out because everyone who is trying to bring a business from private to public has an exit point, and it's in their best interest that those IPOs are as attractive as possible. So they're going to build that sentiment and narrative and, essentially hope to list at a very high price to get their exit liquidity and, make a dollar at that time, but then maintain that obviously for a while so that they can sell down maybe their relatively large holdings. Beyond that story, just jumping straight into like what's happened with Guzman y Gomez in the last year. Well, the story was it was going to expand rapidly. It's going to take over McDonald's and store counts in Australia and go gangbusters overseas. So they're touted US as a growth engine. They've got 8 stores in the US and they're losing money in the US. So I don't know if you've been to America and had Mexican, but there's a Mexican place on every corner in the US, and most of them are far better than Guzman y Gomez. The last time I was there, I had Chipotle, also not going that great at the moment, but yeah, it was pretty good just as a consumer. And then you've just got so many options. So I think that would be terribly difficult for them to compete in that market, and yet they're going there. So it's also not the end of the world, right? So there's the valuation, and perhaps the earnings report is not matching the growth that is baked into that valuation. So it's come down quite a bit over the last week as well as the last year. And so is it the end of the world? No, not really. It's still growing inside of Australia, right? So I think you'll find that revenues are up sort of something like 17% overall, because inside of Australia it's doing quite well. So outside of Australia not doing so well, but inside its core market it's still growing. So maybe if they keep that trend going and you can see valuation go down to a point where it becomes attractive, that'd be great. But I think if you look at it right now, the PE is maybe around, actually, to stay on Chipotle there, the PE for Guzman y Gomez, which is like a really comparable restaurant style to Chipotle, is in the 80s, whereas Chipotle is at 32. So even then, comparables to something like Collins Foods Group, which owns a lot of KFCs in Australia, you will find that as a comparable to this long-term company, 103. I'm not sure what's going on there, but you would find
this is the honourable Google Finance leading us off track.
Yeah, I think you would find that a lot of fast food restaurants trade between sort of 15 to 25 PE. Even like a really well-known US brand like Shake Shack that's expanded overseas, got a lot of stores across Asia and Middle East. That's a more expensive fast food restaurant. It's like at a 25 to 30 PE. So when you're paying 3 times that amount for every dollar that Guzman y Gomez comes in, I just think that's a bit excessive. So you have to be really careful, no matter how much you like the burritos, what you're going to pay for that business. Like as a business owner, I'm not willing to invest that for the return. Similarly, step one. So step one, it was another consumer-facing brand that I thought, it's not going great. So over the last year, and I think it's close to nail in the coffin here. So if you look at the share price, it'd be down well over 70% in the last 12 months. If you don't know what step one is, it's essentially male underwear that you can get online. They have had pretty much a horror quarter where you've seen gross margins go down. I think their margins have almost halved. So you don't want that when you're a direct to consumer brand. Revenue is declining as well, but what makes it a little bit more frightening is their employee costs has actually gone up at the same time as well. So they're bringing in less revenue. The revenue is less profitable, and that is part of the reason of that is because their employee costs have gone up, which is, it's essentially an e-commerce business. You don't want to have increasing employee costs in a world where, essentially technology is getting better. You would want to see margins going up and employee count going down if you were the owner of an e-commerce business.
Yeah, definitely. Do you own either of these businesses? I'm guessing no.
No, gosh, no.
Yeah.
No, but I can say I have owned Nick Scali in the past. I think Nick Scali is actually one of the best retailers in Australia. Like it probably competes with JB Hi-Fi in terms of like a well-operated business. That got absolutely smashed probably for the same reason as Guzman y Gomez, where there is some growth, particularly locally, but their international work. So Nick Scali acquired a UK business last year, I think, and that expansion is just going to take time. That acquisition is going to take time to become, perhaps as good as the local businesses. And when valuation gets excessive and the reality comes to play, the share price comes down because that valuation, that if you say PE ratio, has come down. So it's still I think Nick Scali is still a good business. I think, a family owned and run business. They've done exceptionally well, particularly with Plush, the sort of more the lower priced business that it owns, rather than the Nick Scali furniture itself. That was actually a really good acquisition and is going well. But yeah, it's valuations come down quite a bit recently.
Yeah, definitely. There's a good question from Jeremy, like why on earth would GYG IPO at these levels? Well, it IPO'd at a very good time for the owners of GYG. If you're investing in anything, you want to know who you're buying from. People just take it for granted that when they buy shares on the stock market, there's this invisible hand that kind of just gives you your shares, and you don't really think that the person who's selling might know more than you. And an IPO is the perfect time to be buying from someone who absolutely knows more than you, because the moment that a stock or a company transfers from a private company and then becomes a public company via an IPO is the moment that the public rules kick in for disclosure of information. Prior to that, they can share information with whoever they want to. But at the exact moment that it goes on the stock exchange is the moment that you have less information. And so that's why it's not just risky to buy shares at the time of IPO, but probably for the first 6, 12, 24 months afterwards. You've got to always ask yourself, who are the insiders and what are their incentives in this structure? And insiders don't necessarily have to mean just like management and that sort of stuff. It could also mean the fund managers who got in before the IPO took place, because they would have got a lot more information, presumably not just through the prospectus, but just in general. We like not to butter our own bread too much, but we called this out multiple times during the IPO. And we talked about, we're going to bring that chart up again today, but we called it out multiple times, and it's a good business, but it was not worth what it was, and that's just the reality. So one thing that I always look at, Leigh, too, is like when I drive around, I see a lot of them in Queensland actually for some reason, but when I drive around, all of the GYGs are almost always brand new. Like they're beautiful stores. They look more like a McDonald's. They've even got some of the same technology and whatever. And I look at them and I'm like, well, that's actually a depreciating asset, which is not what a lot of people think. Like they think of like a beautiful store is great. It's a beautiful store, but it actually is something that does depreciate because in 6 months, it's not as new. So you got to like, yes, those things matter, but someone's paying for it. So yeah, just a little bit of extra thing on the end there. G-Man says, I've largely avoided retail after being burnt numerous times. I think Wesfarmers is the main exception to that. Would like some Nick Scali at the appropriate time too. Well, thanks, G-Man. That's a good comment. I agree with Wesfarmers. I think Wesfarmers is a wonderful, not just a retailer, let's be sure. It's like a much broader than that nowadays, more of a conglomerate / investment company. Have you ever looked at Wesfarmers, Leigh?
Yeah, and it probably touches something like what I didn't mention, which was point 2, is that consumer brands need consumer spending. And every time I go to a Bunnings, I go, gee, I need to own some Wesfarmers shares because, wow, like Bunnings is packed all the time. And then you can look, at broader trends, like where do, Australians spend their money, obviously renovating and keeping up their properties and things like that, like drives a lot of spending. I had previously owned Beacon Lighting for almost the exact same reason that I'm saying right now. Is that where do consumers spend their money? Like if consumer spending is becoming really tight because there's cost of living pressures and things like that, ordering a lot more underwear online, which could be a premium brand, is probably not where I would think that consumer spending is going to go. But Reece Plumbing has had a good bounce back, but over the long run, it's spectacular return. Wesfarmers, similar. Nick Scali, like it's furniture. Like obviously we have a growing population and there's some sort of cycle time on furniture, but with more and more housing investment and more population, you can imagine that something like JB Hi-Fi, Nick Scali, Wesfarmers, and maybe Beacon Lighting, although I haven't looked at the company for a while, rather than something like Step One.
An important misconception about Beacon Lighting for folks that don't know it that well, it's not like yes, it makes money from its retail stores and all the likes of us just wandering in there and buying a lamp or something. But a big part of its trade is actually to trades and to other professionals. So more B2B. And that's what gives it so much resilience throughout the economic cycle as well. You're almost always better off selling to other businesses when markets get a bit shaky, because they're not the ones that are paying the ultimate fee. So just a bit of a tidbit, if you can find a business that sells to other businesses, it's almost always one step removed from the consumer psyche. And so it's something to keep in mind, looking at all these charts, JB, Nick Scali, Wesfarmers, Reece, it almost seems like we should just buy the best companies and just leave everything else for everyone else to just trade and to punt on, because the longer you zoom out, the up and to the right seems to be the kind of status quo with these really good businesses. There was a wonderful meme here put together by Leigh. If our design team could see this, they're probably getting their own sickle ready for Leigh when he comes back in. But the general idea here is that we spoke about it last week. Companies like Xero, WiseTech, Technology One, Pro Medicus, basically any of those tech stocks. It's basically been a reminder that even the most quote unquote beautiful software companies may be not worth what they once were. And we can bring that up just in a quick reflex with the share price, just so people can see what we're talking about. That's arguably the share price of Australia's best company of the past 20 years or 15 years. Like that's a hell of a share price. And then you've got something that Leigh brought to us last week, which is Technology One. Another fantastic company being sold down, although Leigh managed to pick the bottom. The Gant effect in reverse order. Same with WiseTech. Obviously, there's a bit of, let's call it shenanigans with this company before the AI kind of bit. But we've been writing a lot about this lately. And ultimately, this is kind of, I didn't even know you were going to put this together, but it's kind of like those steps or stages that I mentioned over the last few years. People went from AI being kind of this useful tool to, hey, maybe it can do this little bit for me. And now they're thinking, holy heck, maybe I can get it to do like everything for me. And that has sent the sentiment way south. And it's fair to say that basically all those technology companies we just spoke about are effectively, or were effectively, extremely highly valued. So like Pro Medicus, there's a good question here or comment here from Montgomery. I've been learning about price to book. Is it as useful as PE or not informative at all? Or informative at all? Leigh and I mentioned price earnings ratios, PE ratios, a bit already today. You could do price to the book value, which is the balance sheet. You could do price to cash flow, price to whatever. These are just heuristics at a point in time. So heuristics meaning that by itself, the number means nothing. It's only when you put it in context of something else that it makes sense. And they're not scientific. So you would use different metrics for different types of companies. So for example, with us comparing like Pro Medicus on the PE ratio, it's probably not really fair. We should probably be using something like price to EBITDA, price to sales. For a bank, which we'll talk about in a minute, you would use price to book. So it's about knowing which tools to use, Montgomery. But good question nonetheless. So we had a bit of feedback on our investors podcast last week to say that Pro Medicus on a PE ratio is not really fair. But it does give you the kind of direction of travel is correct. Like you can't have a $300 share price or multi-billion-dollar company on the amount of profit that Pro Medicus had at the time. Like even if it is an amazing business, as Charlie Munger said, no business is worth an infinite price. So that's really important to understand. Now, back to the task at hand of technology. There's been a lot of commentary around lately, like a lot of commentary around everyone really fearful of what AI means. And there's two ways to think about what AI means to technology companies. One is, does AI do the job for you? Which is how people have traditionally seen the role of AI being like used, like does it do something for me? That's the first side of it. But the second side of it, the one that's made everyone really nervous, is actually not does it do the thing that I think it can do for me? It's actually, can I use the AI to build the thing that does the thing for me? So let me give you an example. Say like Salesforce, which is, I think what Montgomery said before, is one of the companies that they bought. So Salesforce is the world's biggest CRM, customer relationship management software. Put all your customer details in there, send them emails, text messages, keep up to date with what's going on. So when you jump on the phone to them next quarter, you can say, how's your cat going? Because you put it in the notes in the CRM. Well, now you could potentially use AI to build something that looks like Salesforce far easier and far quicker than ever before. And so that's the real threat. It's not the threat that you would just prompt AI and say, hey, what was Greg's cat's name again? It's actually that you would use it to build the thing that replicates the tool. This has huge winners and losers, at least in the sentiment perspective. We're going to talk about some of the winners in just a second. But some of the obvious losers are the businesses that really don't have a competitive advantage in technology anymore. So it seemed like they did just because they were the ones that built the software. But now, maybe they don't. Maybe the software itself isn't the competitive advantage. I'm probably in the camp that software is going to be replicated far quicker. It's obvious. But within that, I'm in the camp that software alone doesn't make a business. It's actually the people, the tools, the problem that they're solving is what makes software. So you mentioned Leigh. Now, as I get off my high horse and my podium, you mentioned last week that you bought Technology One. do you just want to refresh real quickly, like why you bought it, and then maybe we'll jump into some of the blue chip stuff?
Yep, absolutely. So Technology One, I coined the phrase, I've TM'd it. It's a double acronym business, ERP SaaS. You can use it to send, royalties to Rask. You can keep it. The business makes software for councils, governments, schools, and whatnot to do like daily admin, like CRM, all sorts of different solutions for the operations of these businesses. And those businesses are traditionally bureaucratic and slow moving. So the narrative is that AI is going to replace software as a service. That's one acronym, SaaS. That was, the fear that sort of has transcended over all software businesses globally. So not just Australia, all over. And I think we saw a bit more on Friday as Claude released a new solution that could threaten companies like Fortinet and Zscaler, which are like security businesses, digital security. And you just see those companies on the share market sell off very quickly. And so, Technology One is a very, very high quality business. Its revenue for years has been from bottom left to top right. Like it's just growing like clockwork. Same with its earnings. So its profits have been growing as well. And so when a story comes out that perhaps it might be breaking the long-term thesis for the business, it may be justified that the share price goes down, but the share price has come down, or had come down at the time so far, that I just think that the risk of their revenues and earnings being culled that much in the next 3 to 5 years was not true. I just don't believe that. I think that their customers would be slow to change to vibe coding teenagers for producing a new solution. Like they're really slow to move. Owen, when was the last time you went to a hospital? You would have seen software that looks like it was made with perhaps they're still operating like Windows 98 or something like that.
Yeah.
I don't think Pro Medicus is going to be replaced by a quick AI solution or AI created solution. Similar with Technology One, I don't believe that local councils, governments, education are going to quickly change their Technology One solutions to an untried, untested alternative that was vibe coded by someone, meaning that they just point and shoot and said, make me software that does this. Because the switching cost is a lot. Like all the systems and processes for all those businesses then have to change. And interestingly, I think it was the day after or maybe 2 days after, I did invest in Technology One. The CEO came out, and I think Sam Hubbard from Pro Medicus has said something similar, that they see that their products are going to be turbocharged through AI. And it's no secret weapon, like that their employees are using these solutions to make their solutions, their products, like the Technology One products, better and faster, and iterating on whatever the problems they're solving now, even more so by using AI. So I think AI in the short run is actually more like an accelerator for the high quality SaaS businesses. And and so Technology One, as we're talking about guidance, upped their guidance or upgraded their guidance by a bit late last week.
So you're pretty happy?
Yeah, I mean, humbly, I think I'm very lucky that happened. I did not forecast the forecast, but things get sold off like by ridiculous amounts, and for a long time it's been a high quality business, and I just don't think that's going to change in 12 months or 24 months. It may change in 10 years, like for sure, but we're nimble enough to be able to see the change as it happens, and as it does, I can reconsider that thesis.
Yeah. No, you make a great point about supercharging those companies that are already on the ecosystem. So like if they're already software engineers and now they've got software engineering talent to the power of AI coding, well, presumably that gives them a great head start. At least that's kind of been my thesis for the last couple of years is, yeah, these companies, like say Xero, we'll have Xero alternatives. We already do have Xero alternatives, as in Xero, the company, by the way, people, not Xero as in Z-E-R-O, but X-E-R-O. We already do have alternatives to that, and it has grown really well. So I'm not going to give up my Xero subscription anytime soon because there may be slightly cheaper alternative. Like, it's important to understand what competitive advantages there are and so on and so forth. And so once we kind of lift the surface, we can see what's really happening and what software we trust and what businesses we trust. Agreed that over a 10-year horizon or even a 5-year horizon, this stuff's moving pretty quick. We don't know. Just like in the GFC, we didn't know if banks would survive. Just like in COVID, we didn't know if literally any retail business would survive. Just like in 2014, 2015, we didn't even know if the euro as a whole would survive. Like, well, they all did. And many of them emerged stronger. Some of them certainly struggled. Looking at like Greece in particular. But like, there's always these moments in time where we just don't know. And if you have to wait for certainty, you'll pay up for it. So that's kind of the key thing. And a lot of times, I think when Joe Mager appeared on our podcast many years ago, he said he was a value investor in, what did he say? He said, I was in a religious kind of way, not a scientific way. So he was like, I kind of believe that value investing is still like really important, but I apply it through this lens of like generality and this idea of like, I think I'm right, not, I don't have this much conviction, so on and so forth. So working my assets off, so I haven't found any tech on the ASX that grabs my attention, but I did purchase MU and very pleased with it so far. I don't know what MU is.
It's Micron. So
oh yeah,
working my asset off, great name, but also might be getting some inside word from Team Pete at the Rask stock picking championship, which we have also invested in Micron. So well done there. Yes. I mean, I'm not sure where it's going in the future, but if you have enjoyed the recent run up, congratulations, it's fantastic. And someone mentioned earlier that they purchased their first ETF. I've lost the comment, but who has just done their first ever investment into whatever asset, but into the ETF there, congratulations, because that's monumentous for a lot of people just to make their first ever investment.
Yeah, and let alone during when there seems to be so much uncertainty around, which, shocker for everyone, is always. But just quickly, one final thing before we move into this next spot, because you're going to bang the drum for the boom in boomer companies. But the idea of what I think is going to happen next with the technology companies and just businesses in general is, I believe, and I've held this view and I've written about it publicly for quite a while, maybe 12 or 18 months repeatedly now. So sorry if you've heard me say it before, but I think what's going to happen is AI continues to disrupt the broad internet ecosystem of things like social media and even things like Google search and that sort of stuff. I think what's going to happen is everything that lives inside your kind of CRM, everything that lives inside your business already is going to become more valuable to you. Because as in the case of Xero and Technology One, you're going to use the technology to enrich and enhance what you already do for your customers. So you're going to say to them, hey, I know I sold you this, but now we've just done that and it's amazing. Or, hey, we've got this thing and now it's AI enabled and you can get this subscription and it'll be this much more or whatever. And I think that's going to be more amazing, that if you're already in an ecosystem, it's going to be even better. Like take, for example, maybe like booking.com or TripAdvisor or one of these, luxury escapes types websites that you might go and book a holiday on. Well, now you can ask the AI assistant to plan the journey for you, right? And yeah, you could just ask ChatGPT to do that, but it doesn't have all the collective wisdom and history and knowledge that goes into those platforms. So that's an example of how maybe those traditional kind of technology businesses get enhanced. They might not be able to grow as fast because maybe they go to ChatGPT directly or some other mechanism, but that's how I think that's going to play out over time. Not for every company and not all the time, but I think in a good general sense, I think that's what we're going to see. Now, I think that's actually what we're going to see from many of these companies. I think we came out last week, or I should say I came out last week and said that ANZ is basically a pile of crap. And the only reason the share price went up was because it gutted the company, basically. And everyone was like, wow, this is an amazing growth company, when they just woke up the next day and realized it's still ANZ. Now you're saying the blue chips are back, baby. I'm going to share a small cap story in just a second, but why do you say this about blue chips, Leigh?
Boomer businesses are booming on the ASX. So ANZ is one, Telstra is another, Sonic Healthcare, and we're going to actually cover BHP towards the end there as well. But, you know, these four businesses that I'm highlighting here, and you can probably throw the other two big four banks in there as well, NAB and Westpac, have been going great in the short term. So there, and I'd lump the banks in the same bucket as Telstra, where ANZ has been, and this is just on a share price point of view. ANZ, I think in the last 12 months is up around 40%, climbing back to it near its all-time highs. Westpac similar, NAB similar, and it's not because it's a growth story, really. Like, but all of these mature banks are doing their best at cutting costs because their growth is quite mature. I mean, most, like, let's take Commonwealth Bank, 70% of its book is essentially in mortgages, right? So it can only really grow at the rate of mortgages. There's not a lot of business loan books. There's bits and pieces here and there that can, yes, add to the top line, but the top line's not going to grow like a Pro Medicus or some other explosive business. Doesn't have to be technology, but it's not like there's a huge market share that they can swallow up. Like, people are going to have their preferences over the big four banks and maybe some of the other smaller ones, like Macquarie's out there trying to drum up its mortgage business, but they're not going to be able to grow explosively on the top line. So how do they keep improving as a business? Well, they need to cut costs to make themselves more profitable. There's pretty razor thin margins when it comes to banking. You know, they have to be able to cut costs. You've talked about ANZ last week. You know, the new CEO, or relatively new CEO of ANZ, said he was going to come in and cut costs, which i.e. means removing a lot of headcount, and that has happened. So the company has less expenses while the revenue keeps trickling up, so it's more profitable, and that has translated into share price going up. So for people who are holding it, you know, they're receiving relatively steady and growing dividends, as well as some share price growth. I mean, it's sort of rebounded recently but it's only climbing back to near all-time highs. Telstra, similar deal. Like, it can't really grow explosively at the top line. It is the major telco. They haven't I think, like, total revenue only ticked up. It's almost essentially flat. But what they have been able to do is capital management, which means stop blowing money on things and become more profitable. And you'll see Telstra, like ANZ, up quite a fair bit over the last 12 months. So, you know, if you bought at a low and rode that up, you'd be quite happy, and collecting dividends along the way. Sonic, you know, is also one of those stocks that's, you know, if you're a healthcare investor, you probably own Sonic. Like, if you're a traditional ASX 200, you know, picking the best companies in the best sectors, Sonic is often mentioned there in healthcare. It's a diagnostics business. Obviously, during COVID went gangbusters because, you know, we needed diagnostic. We needed what Sonic did. So, you know, its revenues did grow explosively in the very short term, but that's kind of like a once-off thing. It's not something that was going to be maintained forever. But at the time, who knew? Who knew it wouldn't be maintained forever? So obviously, you know, the share price got bid up there. Since then, on the decline, but you know, recently has been able to sort of reduce some of the expenses and get acquisitions in line to become a little bit more profitable, and the share price is rebounding off the lows. But, you know, if we just take a step back and have a look at all of those businesses, the common theme is there's no chance for real explosive revenue growth. It's more is the management thinking about business long term, and can they cut expenses to ensure profitability and stability in those businesses? And the answer is yes. So, you know, for all the boomers that think investing is easy, they're probably right.
Well, yeah.
Honest again.
See, this is an example of what we were just talking about. So, working my assets, I've asked the question about ANZ cutting jobs. This is effectively what's happening. Is we're seeing productivity improvements per person, per dollar, per whatever you want to call it, within these giant businesses. Like AI has the potential, just broadly speaking. This is not always the case related to AI, but just to bring it back into the fore here. Is if you have the ability to adopt these technologies faster than everyone else and replace these roles faster, you are going to move ahead. And in the case of Sonic, I mean, they're probably not using that much of it, but it's more as capital management, it's prudence there. And they're able to fortify their business. And it's a really interesting time in markets, because for the first time in quite a few years, we're seeing the old guard fly ahead. And the new upstarts are kind of trudging along down below. So one of the companies that I've mentioned a lot on the Rask network over the last few years is LaserBond. So it's a company that does, it's going to sound fun, laser cladding. So LaserBond is a business, trades under the ticker symbol LBL. Effectively, you don't go to it, but like a mining company or a mining company contractor would go to LaserBond and have components or parts for their big Tonka trucks or their conveyor belts or their wind farm increasingly repaired. And the business has 3 divisions. It's got a services division, a products division, and a technology division. For, I guess, maybe since pre-COVID, when I really started following the company, so that's like 7 years ago now. Yeah, well, 8 years ago. So LaserBond is a business that effectively can repair your equipment if you're one of these businesses. And it does an exceptionally good job of it. And one of the things that you would use it for is that they can repair your equipment to a standard that's better than buying it brand new. And it's really good for the environment because it's about 10 times stronger. So the business has struggled. Like, when I say struggle, it's gone sideways because people got really myopic. Myopic being short-term focused. And now all of a sudden people think, oh, well, it's actually kind of bouncing back. And I'll just bring up some of the slides here real quick for you, just from the latest announcement and the share price jump. So this is my winner that I could think of from this reporting season, by the way. So we can see some pretty solid metrics across the board. Don't be too focused on the profit. There was some things that happened in the last year, but profit is sequentially looking very good. So if we look at, say, the last few halves, you can see that in revenue terms, the second half is a lot bigger than the first half. So a lot of people, when they're short-term focused, they'll just see like revenue or profits falling or something like this. And there was a few other things that happened. But ultimately, it's the trend line that matters when you're a long-term investor. Like, is the business structurally getting better? And you can see that continuously happening here. And I think the outlook for LaserBond is probably as exciting as it's ever been, in my opinion. Still a very, very small business. Keep that in mind. Like, we're looking at a sub $50 million revenue or sales business per year, but it's found multiple ways that it can win now. The services segment, which is the repairs, you can see it's kind of holding its own. There's been some efficiencies in the cost base. The products division, which is where it makes products for its clients from scratch, is starting to be resilient and look like it's growing quite well. So over half, still pretty strong. And then finally, the most exciting part of the business, which is what would have got everyone excited about the share price, is effectively there are some deals in motion in the technology segment. So they own part of this business called Gateway, which is growing, and they license its technology, so the LaserBond technology to it. But they also signed a deal with Komatsu, which is on track for this year. So the core business units are growing while they're putting more of this laser cladding technology into other businesses to use, which is the big kind of free kick that they could get in the long term. So very small business. I was actually really, really pleased with the result. It's a winner. It goes under the surface. Not many people even know it exists. So I like this business. I'm not saying that I don't own it right now. I did own it quite a few years ago and sold it. And I just think it's a really compelling small business that's kind of immune to a lot of the things that we talk about when it comes to disruption or these types of things. I like it. I like it, Leigh. It's a small business and very different to the business that you're about to talk about.
Yeah, we're going opposite ends of the spectrum here, where I'm talking about the biggest businesses on the ASX. And full disclosure, I don't own any of those previous big businesses, nor do I think, just because they're the winners now doesn't mean they're going to be the winners next year either. But looking at the upcoming business, perhaps this could be strengthening its position, even though I haven't checked today, but it's either number 1 or number 2 on the ASX, and that's BHP. So I'm not really talking about the share price. Of course, the share price is up in the short term, but we're trying to look at the underlying business. Like, has the underlying business improved in the short term, and does that strengthen its case for the long term? And I actually think it does. So BHP traditionally has been thought of, or at least for my behalf, I've thought of it as an iron ore business, and the majority of its revenues have come from iron ore. Yeah. But in the past, in the recent report, for the first time ever, its copper operations contributed like a record amount of operating earnings, its EBITDA. And while its revenues are growing as well, it's more that. And why I think it's quite interesting is it's not just that copper has contributed so much, but like the byproducts of the copper mining has also increased. So it's gold, silver, and some other metals. So essentially when they're mining copper, the side bonus is that they've just also mined some gold and silver and other products. So little bonus there, which BHP really needed more money. So they struck gold. Lucky for them. Why do I think it's strengthened? So we've been talking a lot about technology, AI, things like that over this webinar and the previous webinar. Electronics need copper and a lot of you zoom right out, like not just electronics to do with AI. It's like all electrification requires metals like copper. Some require silver, gold as a conductor as well. So I think if you're improving your operations as a miner and are in the right spaces, and you've then got probably currency going in a favorable direction, it's like multiple arrows of progress as it's known. And I just think, wow, like BHP, perhaps it's lucky or perhaps it's genius. They're sort of just right in that right spot right now. I guess that's why sentiment is also right behind it as well. It sort of has jumped up and down. Like if you went on like a 3 to 5 year, it sort of jumped up and down between maybe like high 30s and low 50s. But the share price is now above that. And I just don't really see, I'm not really into mining. The cyclicality of mining and being a price taker rather than a price maker makes it difficult to really predict future revenues and cash flow. But for me, I just see that and go, wow, BHP is in a pretty solid position.
Yeah, well, this chart here, apologies if it's a bit hard to see, like if you're on a mobile device or something, but the orange, which is interesting, is the copper. The green is the iron ore, and the purple, is the coal business. And you can see this kind of long-term trajectory. And as you said in the slides, that businesses don't move in straight lines. Well, that trend in copper production and copper revenue is pretty amazing. And copper prices have obviously been extremely good for these types of businesses recently. Coal, not so much. Iron ore has held its own. It's a wonderful business, isn't it, when you think about it, like the diversified mining base. So they've had that simplification program going for a while with they sold out of petroleum or oil and gas to Woodside, and they've simplified their product suite. But overall, like the global mining giant is like so hard to go past that. Even Rio Tinto, which is a massive business, is still like it's got like some of the Mongolian assets and some of the other assets focused on copper, but more kind of, I would say, focused on iron ore as a general gist, versus this business, which is truly diversified. So it's really impressive. And I guess there's something in that, Leigh, like some of these businesses are over 100 years old. So they've been able to be resilient through super cycles and busts and so on and so forth. So
yeah, I mean, even BHP is a perfect example, right? Like BHP mining iron ore really benefited from like the Chinese real estate boom. It's probably like now over a decade ago. And it's now back into contention for the largest market cap in Australia because of something else. So they've been able to see through a boom and bust in its core revenue generator and move forward into another one. It's extraordinarily impressive at that size. Like that's impressive at a small business level, but to do it at a giant business level is nuts to me. It's absolutely
remarkable. It's remarkable. For folks, if you want to come back and you want to hear us talk about stocks and answer questions and these types of things, we'll be back next week, same time, same place. Well, maybe not exactly the same place. It'll be a new URL, but it'll be on the Rask YouTube channel and also in the community. So if you're at community.rask.com.au. As Leigh said, there's a lot going on this week as well, as what's just happened. And next week, we've got a bit of a kind of a roundup and look back on some of our best players and those types of things. I'm going to keep diving into LaserBond because I actually think that it might be worth me looking at again. I know someone here said today that they owned XRF Scientific, which is another one of my favorites. These two small industrial businesses on the ASX, two of my absolute favorites. There's also a couple of good podcasts coming up, particularly on the Investors podcast over the next week. We've got small cap fund managers and also some other things in the works. So we've got Magellan coming up talking about booking holdings. They go deep. Mitch and Alan from Magellan go deep into booking holdings, which is the owner of booking.com. And I hope they're right because I'm headed offshore next week and we've used booking.com for almost everything. So hopefully there's some secret in there. But just remember this is a message from both of us. This is the same chart that shared at the exact day that GYG IPO'd. The longer you invest, the more the fundamentals matter. So if you're investing in individual companies, even if ETFs, because the ETFs invest in the individual companies underneath, the longer you invest, the more the fundamental drivers and value like being created within the business matter to you. And this is probably more true now than ever before. Like Leigh said, the companies that are winning right now, like the banks and these types of companies, is that strategy sustainable on a 5 to 10 year view? Maybe, but maybe not. So it's up to you to determine if that's a worthy bet of your money over a long period of time. There are some absolutely wonderful businesses on the ASX. Some of them have been absolutely crunched recently. And so remember, if you're waiting for that kind of clarity and that perfection, you might let that get in the way of progress in terms of allocating capital. We'll be back next week. You also get the Sunday email from us this weekend that will alert you to next week's webinar. But don't forget to head to raskmedia.com.au so you can see daily news feeds on the most popular companies. You can see what Leigh and the team are writing about, myself included. But Leigh, thanks for taking some time out of your lunch break on a Monday. I know you're super passionate about this. You probably do it anyway, but really appreciate your time, mate. And good luck with Technology One.
Yeah, thank you. Thanks very much. I'll be looking at LaserBond now, so I'm excited. Thanks, Owen. Great to have you all with us, and look forward to doing it again next week.
yeah, thanks everyone for joining us. Enjoy the rest of your Monday. Good luck with the rest of the reporting season, onwards and upwards, and we'll see you in about 7 days' time. Bye for now.